17.2. Our objectives for this section are to explain the purpose of accounting, describe how property rights are measured, define the three components of the accounting equation, and describe the three main financial statements used by businesses. Before we begin, this is a very lengthy section. It has a lot of vocabulary terms, so you will probably want to stop and take notes frequently and then pick up the lesson as you're ready to move on. And this is just a brief introduction into accounting. This accounting really goes much, much deeper than what we are going to discuss in today's lesson. So accounting is the systematic process of recording and reporting the financial position of a person or an organization. So imagine that you want to open a restaurant someday. So you'll need to buy or rent a building to house a restaurant. You'll need equipment to cook the food and furniture to seat your clients. You'll need to hire employees, so some people to cook the food for you, unless you're doing it yourself, some people to serve the food. You'll also need to buy the food and supplies, of course. And before and after your business opens, you'll need to keep track of all the money that you spend and receive. This aspect of business is what's called accounting. So as businesses are doing their business, they need to keep an accounting system to collect and record and report their financial transactions that affect the operation of the business. So small businesses might hire an independent accountant, and large businesses might hire an accounting firm in order to manage their financial records. Another aspect of having an accounting firm manage your records is they can also do an audit, which is a review of accounting records and procedures for a company. When people decide to study to become an accountant, usually the goal is to work for one of the big four. And this is how the largest accounting firms in the world are known as. So they are PricewaterhouseCoopers, Deloitte Touche Tohmatsu, Ernst & Young, and KPMG. And I've known several people who worked for all of these firms, but one of my closest friends is a partner at PricewaterhouseCoopers. So she gets to travel internationally, doing transfer pricing and helping companies manage their international aspects of their company when they're relating from one country to the next and things like that. So it's really exciting, lots of math involved in being an accountant. Because it is so vital to the communication of financial information, accounting is also called the language of business, and it has its own terminology. So everyone involved in a business should understand some of the basics of accounting. A business manager, an employee, or an investor can use this information to gauge the health of the firm that they're working for, or if they want to invest in that company. And all accountants have the same set of rules. They're called the Generally Accepted Accounting Principles, or GAAP for short. And these are used to help prepare the reports and also to communicate the financial information to others. So each company is going to set up their own accounting system to whatever their needs are, but all businesses will follow GAAP. So regardless of if you are doing the accounting yourself or if you're hiring somebody to do it for you, you will follow the generally accepted accounting principles. All right, the right to own property is a basic to a free enterprise system. So property is anything of value that is owned or controlled. When you own an item of property, you have a legal right or a financial claim to it. Businesses also own and control property. One of the purposes of accounting is to provide financial information about property and rights to it. In accounting, property and financial claims are measured in dollar amounts. Of course, this is from the U.S. perspective. So in Korea, it's probably measured in won. These amounts measure both the cost of the property and the property rights or financial claims to the property. Assets are property and other items of value owned by a business. They are either current or fixed. Current assets are assets that are either used up or converted to cash during the normal cycle of the business. The normal cycle is usually 1 year. Cash, supplies, merchandise, and accounts receivable are all current assets. Accounts receivable is the total amount of money owed to a business. It represents money to be received in payments after goods or services are sold on credit. Fixed assets are items of value that will be held for more than 1 year. These include equipment and buildings. The accounting term for the financial claim to all assets is equity. Equity is the present value of an asset less all claims against it. Oops, I went back too far. When a person or business buys property and agrees to pay for it later, they are buying it on credit. The business or person selling the property is called the creditor. Liabilities are creditors' claims to the assets of a business. They are the debts of a company that a company has incurred. Liabilities are measured by the amount of money a business owes its creditors. They include accounts payable. Accounts payable represent the short-term liabilities that a business owes to creditors. And then owner's equity is an owner's claim to the assets of a business. It is also referred to as the owner's capital in the business. It is measured by the dollar amount of the owner's claims to the total assets of the business. If this is a large corporation that has stock, sometimes owner's equity is referred to as shareholders' equity. So a lot of terms there. The accounting equation is pretty basic. The accounting equation ensures that all accounting records will be correct. It is a rule that states that the assets must always equal the sum of the liabilities and owner's equity. As a result, both sides of the equation must always balance. The accounting equation is expressed as assets equals liabilities plus owner's equity. The assets side of the equation shows the value of everything that the business owns or possesses. The other side shows the rights to those assets. Liabilities are the rights that the creditors have to the assets. Owner's equity shows the rights that the owner has to the assets. For example, if a company's assets are worth $100,000 and liabilities against those assets are $40,000, the amount owed to creditors, then the owner has $60,000 in rights to the assets that the business possesses. Financial statements. The accounting system is designed to generate financial statements and reports. Financial statements are documents that summarize the changes resulting from business transactions that occur during an accounting period, the period of time that is reflected by an accounting report. Financial statements provide information that business owners use to make financial decisions. Even small sole proprietorships must prepare financial statements, but these documents are usually only for the owner's purpose. However, the federal government in the United States requires corporations to release their financial records to the public. Stockholders, employees, banks, and investment companies use financial statements to learn about the financial condition of a business. They can compare recent statements with earlier ones and evaluate the business's growth or decline. The main financial statements used are income statements, balance sheets, and statement of cash flows. At the end of an accounting period, you want to know how much money your business made or lost. You will want to know if your total revenue and sales and where your money went. This information is reported on the income statement. The income statement is a report of the revenue, expenses, and net income or net loss over an accounting period. It is sometimes called a profit and loss statement or a P&L. If a restaurant's total revenue or earnings is greater than its total expenses, then it has a net income. If expenses are greater than revenue, then it has a net loss. Managers use income statements to see if revenues have increased or decreased from one period to another. Income statements for different types of business operations vary in content. A service business would have sales, expenses, and net income. A merchandising business would also include the cost of merchandise purchased for resale. A balance sheet is a report of the balances in all assets, liability, and owner's equity accounts at the end of an accounting period. It is like a photograph of the business's finances at a specific moment. The balance sheet applies the accounting equation. When added up, the two sides of the equation are equal or in balance. Managers and investors look at the balance sheet to determine if liabilities, which are the claims against the assets, are increasing too much. The balance sheet can also indicate if there's too much cash available. Too much cash can mean that the money is not being used efficiently. The income statement and balance sheet show important financial information. However, neither shows the cash position of a business during an accounting period. Cash flows are the money that is available to a business at any given time, the actual money. The statement of cash flows is a financial report that shows incoming and outgoing money during an accounting period, often 1 month, quarter, or year. One reason that a cash flow statement is very important is that firms can run out of cash even when they make a profit. In today's world, most things are sold on credit. Credit sales are considered revenue to the firm. Businesses that do not receive credit payments from customers right away may not have cash available to pay bills. Cash flow is very important, especially for a business that wants to borrow money. Lenders and investors expect business loan applicants to be able to show a consistently positive cash flow. This gives lenders more assurance that the loan will be repaid. Today, most companies use computer programs to simplify their accounting procedures. Computer spreadsheets are important tools for organizing and analyzing such data. A spreadsheet is made up of rows and columns. The columns are identified by letters and the rows are identified by numbers. As you create a spreadsheet, you enter numbers, labels, and formulas into cells. Cells are the small boxes within a spreadsheet. Microsoft Excel is a spreadsheet application that is commonly used in business. Accounting software such as Peachtree Accounting or QuickBooks are programs that help people and businesses manage their finances. And these are going to be used by people who are sole proprietors or small businesses and haven't hired somebody out to do their accounting for them. So again, that was a lot of information in a short amount of time. You may need to review that a couple of times before class.